This is part two of creating and exiting CVC investment portfolios with GE Ventures. In this part, we discuss more about the exit and part of the discussion from our session. In part one, we did more of an introduction of CVC and an overview of GE Ventures. You've given some fantastic learnings and that here. Could we just go into a little bit more about the exit? So when that decision was made that GE is going to get out of venturing, it's going to push to the business units, how big was the portfolio then and what themes were they in?
So at the time, you had the discussions about strategy. It's not like it just happens like that. It's like the old Seinfeld thing. It's like tipping over a Coke machine. It doesn't go the first time. You rock it a couple times, and finally a decision gets made.
Okay.
And there's a lot of discussions about, what's the best way to do it? Do we just stop investing and just harvest? And that takes a long time, but it maximizes value. Do we continue to co-invest in follow-ons? Do we sell off the portfolio in chunks? Do we sell off the late stage? And when we decided to sell, we were, because we were growing so rapidly and investing so much, we were probably at 120 to 130 names in the portfolio,
okay,
all through the life cycle. We probably had, on a FMV basis, up to 500 million in portfolio size to work with. And that, you would think that gave us more optionality than it would for a small portfolio. It actually gave us less. And again, with the alignment, when we started talking about exit, the assumptions within an organization, people want to see in the BD and the finance organization, they want pretty PowerPoints and they want Excel spreadsheets that do discounted cash flows and well, you valued this company, you're positioning it at $17 million. So we'll haircut that and assume you get out for 15. And we were like, whoa. This isn't something where, you just say it's for sale and you're going to get 30 people lined up at your door. This is a hard slog. The company gets a say in who comes into their cap table. There's ROFRs on a lot of these. There's tag along and drag along rights on a lot of these. It's not easy to get out. And the spectrum of buyers, unless you are, it's easy for the companies growing like a weed who investors can't get into fast enough are relatively easy. It's the ones who are sort of middling along. They're doing a lot of POCs, but they haven't really hit yet.
Yeah.
And those are the tough ones to find investors for. And so we did it in a number of portfolios. We had harvested a number. We got individual buyers and some. First place you want to go is the CEO of the company. They know who they've talked to, who is interested, who's hanging around the bush. And if they're doing a new round that's up 10% and you're willing to take a 10% haircut, they can now offer up people a combination platter that gives them a discount. They get in to a company with a rising share price at a discount. So, there are options to do well there.
Yeah, and I think the session we're going to be doing with this 8-part case study that on the 25th of November, we really get into that depth because I think it's, as you've said here, there's a few points that the reason why that startup wanted the strategic in there to start with because they want the GE logo. Now, if you're not going to do follow-on, that's an issue. If they didn't want to do an exit and some of the financial people want to do an exit, but you don't want them to pivot into another area, there's all sorts of issues and dynamics there. Yeah. And as you sort of said, when they get the call from you saying, oh, by the way, our chief executive has decided we're changing, follow-on money, relationships, on all sorts of stuff, really sort of stuck in there. So I think that's a great point you made there. Get back to the CEO, because that's where that discussion and conversation and that goes. And I think also the other great point you made is the people typically in the corporates, the CFOs and the business units, they're used to dealing with major mergers and acquisitions, and they've got a big bank and they've got big consultancies who are saying, oh, we've looked over all their numbers and they're on the market and they've got lots of sales. Of course, we can do discounted cash flows on that. But as you're saying,
Right.
when you've got no profits, you've got no costs, you're doing development, you've got
Right.
nothing to do your metrics and that on, which is really important when you get to doing those sort of points. So great. Look, let's hand over, get some questions. We've got some questions of that now. So on the reasons for setting up as a fund, and also financial return. Agent,
We were to invest off the balance sheet, which means a number of things. First of all, you keep in mind the life cycle of a venture investment, depending on what stage, if you're getting in seed versus late stage, whatever, call it 7 years, is much longer than any CFO is thinking. And so we would have to go to the organization every year with a budget for how much we're going to invest, and get approval for that envelope. Didn't mean the envelope was there through the whole year, but it gave them a sense for when we came and said, okay, we're cutting checks, that it was within that envelope. We didn't know, and we had to guess at what follow-on investments were going to be and how much we were going to participate, how many new investments we were going to have. It was horrible when we would finally get traction with the business unit and they would say, and we would find investments, and then we would go back to corporate and say, well, can you skinny down this quarter? They have different goals and objectives. They're quarterly driven, they are annually driven, and we were trying to look out over a 7-year life cycle. So I think the timing makes it very, very difficult. And when you've got committed capital, you can make those plans for the life cycle of the investment and the fund. Second is governance. We were very, very, very fortunate within GE Ventures that we set the governance such that we had 5 voting members on the investment committee, 3 of which were within GE Ventures. So technically we could approve all our own, and it didn't have to be unanimous. We could approve all of our own investments without any say from outside of the Ventures organization. I think that is very, very, very rare within corporate VC. You generally have to go up and get sign off from 1 to 20 people, and who don't understand venture capital, who aren't looking at 7 to 10 years and say, what are they going to do for us? And it's very difficult to answer. When you set up as a fund, you have very well-defined governance. Who's making the decision? How are they making that decision? And that flows through the decision-making and the types of investments that you're going to get into. You can take a long-term view. You can take a peripheral view. Our most successful investments, both strategically and financially, were almost always ones that the business unit didn't want us to make. Either it was too close to core or it was too far from core, and they said, well, I don't know why you want to do it, but it's your balance sheet, go ahead, or it's your budget, go ahead. I'm not going to object. And then they came back later and said, I see where you were going with that. I'm so glad you made that investment. We love engaging with that company now.
Yeah.
So I got a little off the fund side of it, but it's primarily committed capital. You saw the 5 years that most corporate venture groups last. If you have a fund, funds generally have a 5-7 year investment period plus a couple of years and then roll off at the end. That gives you the committed capital that you need, and then governance, the ability to make your own decisions. Third, very difficult for corporates, is carry. To be honest, they don't like to talk about pay, but we were told explicitly, we don't want to see your ventures team getting rich off the back of GE. I get it. We tried to say, well, they're only getting rich because you're getting richer. Those discussions don't go over very well. But if you've got a fund, you actually have something very dark, your IRR to, your returns on capital, et cetera, and show your success. So that's a third reason I would give for that.
Yeah, no, great points there, David. Are we strategic or are we financial? And I think your points have been very clear. You've got to be both. You've got to do it as you described, sort of within your swim lanes, but you've got to make sure you make that sort of financial return. And I think the challenge that a lot of corporates have when they say we're strategic, and I say, well, why do you call yourself strategic? And then they say, well, the business units decide where we're going to invest. And my often response is, but no, that's tactical, because the business units are probably quite short focused, and they want a new bit of technology in the process, or in their current process, or they want those other bits. And you illustrated very well there that when you made the decision on the longer term where the money is going and where it's the technology and the thing is going. So
it's not what can they do for us, is what can we do for them. I think the concept in getting in there was right. We see where this business is going. We see where solar is going. We see how it aligns with power. Trying to buy into a company and making them do what you wanted them to do for your benefit is I think, that's the typical corporate reaction, and the absolute wrong one. And what you should have been, what we should have been, and what corporate should do, in my view, is help those companies and say, what can we do for you? Where do you see it going? You go to the customers, you get, and that will pull us through, as opposed to trying to force it down the other direction. It rarely works that way. It's funny that they got the investment done at the business unit level. And I think a lot of business units did that to sort of force their people, hey, we've got an investment in this. You got to engage with them now. We've got to make something of this, because we put our, we put our own dollars on the line. It's not the ventures people's dollars. This is ours. We got to make it work. Whereas we would go out and say, if this is where the business is going, who's leading in that space? Let's put some money in them, and let's ask them where they see it's going, and make introductions to that. But it's a great case in point.
I think that point, to reinforce it, the session we're doing on the 11th of November, we're going to look at this whole sort of value chain sort of perspective, and saying, okay, well, this is happening in this part of the value chain, the technology, this is happening in this part of the value chain, and the business models. And I think the advantage the CVCs do, back to the sort of looking at the top of the crow's nest, you might make an investment in one of these ventures, and I think you just touched on it, Sammy, that it wasn't quite that technology, or it wasn't quite that team that made it. But when you're in the trenches there with that startup, and you're seeing what was winning and what was losing, then you know that you could pivot and invest into something else. You know you could pivot the business unit of the insight. So that elevator discussion you had, that you mentioned, sort of, David, the fact that a business unit head could say, do you know what? David gave me a great insight that this venture we invested in isn't quite right, but wow, there's this one over here which is changing, which has changed my insights of where the strategy and the sector and that is going. So I think that's I think some great points in that there.
Again, it goes with alignment and who you're reporting to and all of that. So in tracking is hard for a couple of reasons. First of all, funds don't track performance the same way that corporates generally do. And so we would have markups in the portfolio, that we would mark up the portfolio depending on how you do your accounting, that either went to P&L or it didn't go to P&L, and then impairments always went to P&L. So we would get the drag of that without the lift a lot of times. And then it's cash versus non-cash. We could sit there and say we're marking up the portfolio and we're doing great and all of that. We go to the CFO and goes, well, why do I keep writing you guys checks if you're doing so great? It's like, well, we're making investments, and et cetera. And then the other side of the coin is also the expenses. Who is actually getting charged against those investments? And within a corporate, it's a lot larger team usually than, and there's a lot of allocated expenses than you would get in a fund. A fund is very defined. Here's your expense ratio. You guys got to cover your fees out of that. Good luck. Whereas on the balance sheet, there's a lot of allocated costs. Our finance people, our real estate, our IT, all of that was a different organization, and they would allocate us costs, and it became very, very complicated. And then again, you're right. We would be asked on an annual basis, well, what do you think you're going to do from a P&L perspective next year? And we're like, tell me what market's going to do, and I'll tell you what our P&L is going to be, right? And trying to, and we got them to the point where we were doing a rolling IRR target. And we had to build to that over time, but what we were trying to get to was a rolling 5-year IRR. because this is a very, very, volatile business. You have enough. It's funny. We went to the organization and said, what would you do if we had $100 million exit? And they said we'd hate it because look, now I've got to explain to the street why we've got this organization who has 100 million P&L out of the blue, and is there anything that's going to blow up in there? And B, street marks us against regular growth. So all you've done is set my bar higher for next year. They don't care it was a one-off. They just care that it was additive to P&L. So they said, look, I'd love it if you did it. It would be a hard story to sell, but and that's why the alignment and telling the story is so key.
Yeah. I helped in the early days of doing this sort of role, going back 20 years now. In 2002, I helped a consumer goods business set up their venturing unit, and also they'd had one of the big strategic consultancies beginning with M. And in one of their slide decks have convinced the corporate they wanted to sort of do this, there was an IRR figure and that in it. And after 4 years, after they'd spent all the original investment, they came back to me and sort of said, oh dear, we now have to justify to our corporate why we're going to continue sort of doing this. And they'd had one sort of small, exit, which had been successful and given them sort of multiples. But of course, they'd spent their sort of money. And your point, Kevin, about could you do some sort of alternatives? Can you do some comparisons, artificial funds? And we did some research on that in the mid sort of 2000. We published a report on it as well to the corporate venturing community. A couple of key insights we found was a financial fund are always in the top quartile because they pick when they start, they pick their sectors, they pick the metrics they want to be, and they're always in the top quartile of the comparison they do. But this corporate we were working with, it was like consumer goods in Europe in the early 2000s, starting after the sort of .com. Well, what are you going to compare yourself to? So I think it's difficult sort of doing the comparisons to funds. Also, I created a podcast a number of years back with Intel. So one of the world's largest funds, never mind corporate funds, which is in the tech space. So they're in that they're a financial sort of type investor, and you can sort of you can do some sort of comparisons then to the market because they've got dozens of people and billions of dollars being deployed. But I think GE is probably one of the bigger ones. But when you get to some of the others in specialist areas, it becomes a lot more difficult to compare to the market. And I think it's those sort of elevate the discussions as much. And also, I think just the basics of can you write a check? And can you get a bigger one back? That's the simple things that the people in the corporate sort of understand would be nicer to take on it.
Hey, Andrew, I do want to just circle back to Sammy about who I thought was doing it well out there.
Yeah.
I'm happy to highlight that. Look, I can only see from the outside for the most part. Plus, when I talk to people, we don't see the fights that go on internally, and so what might look wonderful, above the surface might be a disaster underneath. But corporate VCs that I think do it really well, first and foremost is Salesforce Ventures has knocked the cover off the ball. From what I understand, their returns would make a financial VC blush. Now, a lot of it's the spaces that they're in. I mean, software, you get a lot more bang for your buck. But what they do very well is they understand what their role is. And a lot of it is BD development. And they're looking for acquisitions. They're a very acquisitive company. So they do it very well. Anybody who's been doing this for more than 10 years is doing it well because they wouldn't be around if they weren't. So the fact that Chevron, Shell, some of those have been around for this long, somebody's doing something right there. They're telling the story right. They're getting the right investments. The people will change. The size of the funds will change. But if you've been around that long, the corporate knows your value add. And so Intel's gone through a whole lot of changes, but they do recognize the value of it. I think other ones that I've seen do it well, Comcast Ventures has got a number of real wins under their belt there. I don't know the internals of them, but I see the successes. And on a lot of investments that I sort of went initially, what the hell's Comcast doing investing in that? But so I I don't know the details, but they seem to be doing well. SAP, their Sapphire Ventures, set up as a fund, doing extraordinarily well. And I think a lot of that, in talking to them, is off the back of the fact that they are an external fund, backed with a single LP, and that's SAP. So those are the ones that come to mind immediately in terms of doing it really well. But success breeds longevity. So anybody who's been around for a long time, they're doing something right. Merck, by the way, which is one of your future speakers. Yeah. Bill Taranto's phenomenal. Yeah. They've done it right.
Yeah, and I'd add Relics, previously Real Sevilla Ventures, that they spoke on one of my.
We found out through experience in the hard way how many people are out there in secondary, and there are quite a few firms out there doing and specializing in secondary investments, both individual one-off buys as well as portfolio buys, which tends to be when corporates get out, they want to get out in one fell swoop, not in piecemeal. I spoke with Ben a couple of times, even before we were getting out, and it definitely an interesting niche. I think once you take the strategic side out of it, everybody becomes a financial investor. And one of the hard things you find is it was strategic for you, that added financial value to you. And when somebody else is looking at it without that strategic angle, their financial returns now require a higher hurdle, and therefore the price is that much lower in terms of secondary purchases. So if you're looking at all of these from a strictly financial outside investor lens, it doesn't always make as much sense as it does to the corporate. And there's a handful of deals, by the way, especially in the oil and gas space, where there are very few financial investors in the deal. It's a lot of strategic investors. A lot of times those are the hardest ones to sell because this is first and foremost strategic to those underlying investors. And a financial investor will come along and go, yeah, no, not interested, or the haircut I'm going to give you is so ridiculous you won't take it because you're doing it for strategic reasons, and I'm not strategic. But yes, there are quite a few out there, more than I thought there were. We use Lazard in our process to bring some of these to the surface, and they've got a whole team that does just this in secondaries for corporates. So there's definitely a market out there. It ebbs and flows with the primary market as well, as you would expect, and the likelihood of exits. But there's definitely a market out there. And I think Ben got a good niche for himself too.
David, excellent.
Thanks.
Okay. I'd like to thank all the participants on the session today. Also, thank you the people who made donations. We don't charge for these types of sessions, but we do ask for donations, and we've been donating to Mind, which is a mental health charity, which is really important in these times, and also to the big issue, which is helping people who are homeless and want to get out of those sort of situations. So appreciate the people who've made the donations for being involved in this sort of session. So David, thank you very much again. Thank you all your participants. Really appreciate it. Look forward to catching up with you at some time in person, mate. It's be good to be in the States.
I think that goes for everybody in this situation.
Yeah. Take care,
everyone.